Welcome to today's webinar. Today we're going to talk about margin protection. Margin protection is another crop insurance tool that's out there right now for producers to use to help protect their risk. It's a fall purchase program. The deadline to buy it is September 30th for 2022, so it's got to be purchased by September 30th of 2021. That's based off your county expected yields. It's not based off your own yield, so each county that's in the program has their expected yields. The projected price and the select cost discovery period for everything is mid-August to mid-September. It's available for wheat, corn, soybeans, and rice, and it varies by county and state. Expected margin is expected yield times projected price minus cost. This is an area-based plan, so harvest yields are calculated by county. It's a subsidized program. The subsidized premiums are from 44% to 59%. This provides a shallow loss coverage from 95% down to 70%. Along with it, you can get a protection factor of 80% up to 120%. You can buy MP as a standalone or with an RP policy. When you buy it with your revenue protection policy, there is some credit provided to premium when buying both. You receive the higher of the MP or RP indemnity. If you have a MP indemnity, any RP indemnities are subtracted out of it, or you get the higher of the two. Calculating revenue to count an indemnity, we need the harvest price and the cost. The harvest price discovery period is the same as what the MPCI discovery period months are. So it'd be October of 2022 for November beans and December corn. And then the county yield is also needed. Your premium due is 9/30/2022. The indemnity received on margin protection could be pushed out all the way to May or June of 2023. When you talk about the input side, and I'm not going to get too much into details, but on corn here, the inputs include diesel, interest, DAP, urea, and potash. It does show you what commodity exchange, the current commodity, the contract month, and then also when the projected input discovery is, and then when the harvest input price discovery period. So for diesel and DAP and urea, that cost is or the harvest price is determined during the month of April. For the MP here, the inputs, I'm not going to go over each one here, but this just shows you on how they come up with the variable cost to the part of the MP program. Exactly how they came up with these numbers, I don't know, but you used your prices times these numbers that they show here, and that's how you come up with it. There's a variable cost, and there's also some fixed costs on it. We're going to get to a quote right away on this. So we're using Rocky County, Illinois on this. The county expected yield is 186.3. As you can see, there's an MP plan, or if you have MP with the harvest price option, the harvest price option is something we definitely take. That's just like your RP program, where if the price goes up in the fall, you want the better of the two prices. It'll readjust your per acreage coverage. So as you can see, you can buy it from 70% down to 95%. When you look at the 95%, if you're going to buy it, that's the level you really need to be at. That's giving you a county guarantee of $895 an acre coverage, but your cost to do that is about $52.34. So the premium, gets to be quite expensive on this. When we go into 2022, we're looking at corn costs per acre before land costs about $600. We're probably looking at about $100 more than last year because of increased input costs. So I mean, it's a very, very expensive program. I mean, it does have a lot of coverage. You have to look at the fall price or projected price is 506. So I mean, we do have a pretty good price for next fall on that. I mean, that's one part that makes it attractive. It comes with expected county yields. You know more on what your county is and average are going to be than what I know they are. So whether this is an attractive yield for the county is really hard for me to determine without talking to producers in this county. If you'd like information on your county, just let me know. That'd be the biggest thing on it. The next thing here, we have a soybean quote. It goes over the same stuff here. Projected county yields is 57.1. The MP projected price is $12.56. As of the corn, we have an attractive fall price. Whether the prices of inputs are going to go up to offset this, it's hard to say. As you can see, the cost soybeans, I actually have a typo there. The 2022, we're probably looking at $350 to $400 an acre before land costs, not $500. And your HPO insurance at 95% costs $32 an acre. So you have very good coverage per an acre again, but the cost is just extremely high. You're better off just selling some grain ahead or coming under the market plan that, on the insurance here. My final thoughts, we went over it pretty quick. The MP insurance is really just like your MPCI revenue protection, except it's basing everything off your county yields, and it's still using the same prices in the fall. But the RP uses your prices in August through September to determine the harvest, to determine what your guarantee is going to be, where the RP insurance will be in the month of February. It is nice when markets are high right now to lock in a higher price. But at the end of the day, we just think this program is just way too expensive. When you're talking, $50 an acre for corn, you're growing 500 acres of corn. That's $25,000. If this doesn't pay, we just think that's way too big of a hit, to the bottom line, for this to hit. The subsidies, the government are paying pretty much half on all of it. At the end of the day, these insurance companies, hire a lot of actuarials to make sure they're not going to lose money on these programs. So, does it look very attractive next year because of the high prices? Yeah, but we could continue with high prices. We don't know where prices are going in the near future. So, with that being said, I don't like spending $50 to $55 an acre on corn when it's already $600 an acre to put it in. You're just adding another 10% to your cost. So I just think the cost and the return on it is just not there. And, we just think that at the end of the day, you're better off buying your RP policy on it, protecting 75 to 85%, depending on, what your area and what your cost is and, what your yields are, and just doing some marketing at that point. We just don't think that the cost of this is worth, what they're asking for it. If you have any questions, you can just feel free to give me a call at 262-707-4112, and I'd be happy to answer any calls you have on this program. Thanks. Have a great day.